Hello everyone, my name is Nathan Hope and I'm a product manager at Xeneta. I will be your host for the next 20 minutes of this air freight market session. I'm joined by Neil, Managing Director of Clive Data Services, and Robert, Business Development Director at the Air Freight Index Company. Today they're here to give us an overview of the air freight market and capacity movements that we've seen throughout this past year. It's important for us to note that neither Clive nor TAC Index will be able to make any forward-looking statements due to antitrust regulations. And so we ask this should be considered when asking any questions. So we'll begin with Neil. And just as a bit of context, Neil's company, Clive Data Services, sources data from the airline carriers. Go ahead, Neil.
Thank you, Nathan. And good afternoon or morning to our listeners. I would like to start off this 20-minute session by giving a global overview on how we've seen the air cargo market develop. On the slide, there are three trends that we've been following. The week-over-week growth from a volume point of view, chargeable weight, and the year-over-year growth in volumes as well as capacity. So let me start off with the bars, the blue bars, which is the week-over-week growth, which we index at 100 for the first week of May 2020. Up until the week of September 28, so October 4. So what do we see here? As many people hoped, wished for a gradual improvement of the air cargo industry, step by step, as we define it. And volumes for the month of September, they were roughly 30% higher than what they were early May, where we're still in the doldrums because of the COVID situation. So that step by step we see the global market recover. The lines at the bottom depict the capacity growth, which is the orange line, and the blue line is the demand growth year over year. And so here we can see that early May capacity was more than 40% down, which is a consequence of the passenger flights being grounded because of the lack of passengers, and the weight was between around the 35% mark minus. So the fact that the capacity plummeted even more than demand meant that the load factor, and we use for the load factor definition, which we call a dynamic load factor, both the weight and volume utilization of aircraft increased because there was just simply far less capacity than there was a decrease in volume. So we see both the capacity creep up, but also on the demand side. On average, we've seen that the dynamic load factor on a global basis was between 7 and 9% higher than last year, so it's quite substantial. If we look at an absolute level, last week we saw a dynamic load factor on a global level of 71%, which is a record. Means flights are very full. And I'd like to hand it over to Robert, who will focus more on a regional perspective and discuss what the consequences of these high load factors have been on price. Robert?
Neil, thanks very much, and good afternoon or good morning to all the viewers. TAC Index is sourcing our data exclusively from freight forwarders, so I guess the two elements, carrier volumes and load factors, and pricing as seen by the buyers, give a quite good overview. So can I have the next slide, please? Okay, so what we are looking at here is the Trans-Pacific route from China, Hong Kong to USA. On the left axis, we see the rate per kilo in absolute numbers. These are then the bars. And on the right-hand side, we see the year-over-year change, which is the orange line spanning across. What is obviously interesting to see is at the beginning of the year, prices were actually below previous year. And then when the crisis started to hit, obviously, then it turned into the opposite. What is also interesting to see is that the yields were actually holding up quite nicely after the first impact of the crisis and are still trading at about 50% over previous year. The next slide, please. Now here we are adding one more component, looking at the rate at the trade route China-Hong Kong to Europe from the beginning of this year until October 4th. So we see the absolute prices per kilogram on the right axis. This is again the orange line. And on the left axis, we see the chargeable weight indexed as the bars. So if we now compare the two, we can see a very interesting development. In the beginning of the year, that was up to Chinese New Year, the price and volume did not correlate very nicely. And this has to do a lot with obviously block space agreements still being in place, which normally end at Chinese New Year. And what we can see is that after the crisis, the correlation between the volumes and the pricing is actually going very well in line. And this obviously is, as I said before, a result of the block space agreements being broken or not renegotiated, and shippers and forwarders and carriers all alike have been negotiating more on a monthly or even weekly basis, and this is why you can see this close correlation between the volumes and the pricing. Now, if we just look at last week, we have a bit of an interesting development. We have seen that the volumes have declined slightly. However, prices are still going up. And that is, in my opinion, a clear sign of people not knowing what to expect. And it will be interesting going forward to see whether there is going to be further volume decrease or increase, and then how the prices are going to relate to this.
Robert, if I may make a small addition to that.
Please.
I think that the decline in volume is likely related to the Golden Week holiday that took place last week.
Correct, but sometimes you then also see when the volumes drop, even for these holidays, that the prices follow suit, but this hasn't happened, at least not last week. And this is why I said it's going to be interesting to see what will happen once the holidays are over, and hopefully peak season is going to kick in. But anyhow, with this, over to Neil, because he is going to look at another trade lane, adding yet another dimension. We had initially just the pricing development year over year, then we added the volumes, and now we are adding one more dimension. And over to you, Neil.
Thank you, Robert. So on this slide, we're looking now at the Atlantic. On the left graph shows you the year-over-year change in dynamic load factor between Europe and North America. On the right-hand side, we're looking at North America to Europe. So let me explain the graph in a bit more detail. The bars are the year-over-year change in dynamic load factor per percentage point. And the orange line on the right refers to the axis on the right-hand side, which gives you the year-over-year change in rate. So the rates paid by the forwarders and the shippers. So I would like to emphasize here what they have in common, but also what is very different between these two markets. And in the next slide, I'll try to explain what is the cause of that difference. So if we look on the left-hand side, so before the crisis hit, we could see that the load factors were actually down a couple of percentage points relative to last year. Then we see this very steep climb because there was so much capacity taken out of the Atlantic market, which is predominantly served by belly capacity, which was no longer there. Then we see the load factor increase by around 25% points for a long time, and it decreases up to about 20% points higher. So the impact on the rates on that specific trade lane, Europe to North America, was that the rates were between 150 and 200% higher than they were last year. If we look on the right-hand side, so the westbound North Atlantic, we see a very similar load factor spike, again between 20 and 30%, although it has gone down a little bit in the last few weeks, but pretty similar to what we see from Europe to North America. However, the rates themselves were between in the last couple of months at least, between 50 and 100% higher than they were on the westbound lane. So the question is, what is driving this difference? Because in absolute terms, the load factor has shown the same development, but the yield is nearly a factor at 3 in difference growth-wise. So if I may have the final slide is where we try to explain where that difference we believe is coming from. So again, on the left-hand side, we see Europe to North America. On the right-hand side, North America to Europe. But now the bars reflect the index capacity, and the orange line relates to the right-hand side, which shows you the dynamic load factor, which measures both the weight and volume utilization. And here we see the difference, what we believe caused also a different response in price. On the left-hand side, Europe to North America, we see that the load factor trailed between the 80 and 90% during the last couple of months. While after an initial spike on the eastbound lane, the other one is trailing between the 60 and 70%. So we believe that the fact that the increase in load factor on the westbound lane caused so much more higher prices than on the eastbound is because of that higher load factor, the absolute height of that load factor. Because if you go from 40% to 65%, which was from the US to Europe, yes, it changes the negotiation game, but there's still quite a bit of capacity that's not being used. If the load factor rises from 60% to 85%, yeah, that changes the game. Because then the forwarder or the shippers might have the fear of losing out. The airlines will probably feel more confident to negotiate, and therefore we believe that the correlation between increase in load factor and price negotiations at price rates is not linear. The closer you get to 90%, the more exponential that price growth will be. Also, Robert showed on his slide from China to Europe this massive peak in rates a couple of months ago. That was when there was really a fear of missing out, and people were nearly handing blank checks to make sure that their PPE materials were being flown from China to Europe. So we believe that we're now getting to the core of that, of explaining why we see with similar kind of load factor developments very different impact on price.
Neil, just a question for you. Sorry to interrupt. Talking about you mentioned belly capacity reductions. Do you think there would actually be a substantial change if transatlantic travel were to actually go back to somewhat normal levels again? Speaking of, when those load factors get up to the high 90 percentiles and it's more of an exponential growth rather than what we would expect to see. Do you think there's going to be any sort of substantial changes to pricing, or is that really even enough capacity availability if the travel were to resume somewhat normal levels?
I would expect if across the Atlantic, when whatever normal travels exactly means, but if we'll see a lot more passengers flying than we see today, I would expect the demand-supply ratio to change, the load factor to drop, and as a result of that, the rates to come down. I think that's pretty normal economics. And it could well be that the speed with which they increased might be matched by the speed by which they will decrease once their capacity is there again. Although I have not seen many signals that return to, let's say, normal passenger travel is imminent. And if I may conclude my part of the story then, and we believe that this mix of very high load factors around the world, as I mentioned, we saw a personal best for the industry again last week with a 71% global load factor. If you're considering trade imbalances, that is planes are full. That with just being the start at a normal traditional peak season, we believe that's quite a toxic unnerving situation for buyers of air freight capacity. Because if that, let's say, exponential relationship between prices and scarcity of capacity is still there, that might have quite some price increases as a consequence. Robert?
Yeah, okay, thanks very much, Neil. Obviously extremely interesting to see how all these different elements play together. And I think also from the question Nathan asked and you reply, Neil, there's one thing that we can say is going to remain, and this is definitely uncertainty. And as a result of this, we also expect, obviously, their volatility. And but most important is really to look into all the elements, the pricing trends, the volumes, and the dynamic load factors. They all impact each other, and only if looked at it in combination, then you will really be able to understand what has happened and to draw your conclusions. Having said all this, I mean, traditionally the situation between shippers and forwarders and carriers has been dealt with by signing longer term contracts. And as said earlier, these have mostly been broken as part of the crisis. And people are looking at new instruments to manage their risk. And there is actually, on the basis of a air cargo index that is now available and widely accepted by the market, opportunities to introduce two kinds of new types of contracts, one of them being the index-linked agreements. These are physical contracts that can be entered between shippers and forwarders and carriers, but also carriers and carriers, basically replacing the current interline agreements. And what they ensure is that every participant in the market pays or gets paid a fair market price. So basically this risk shift from the shipper to the forwarder, from the forwarder to the carrier, for everybody hoping not to be caught in the middle, can be ended by accepting these new instruments, and it will be interesting to see what is going to happen. In addition, it will also be able to go outside of the physical market into the paper market, where you can hedge your air freight spend or your margin by entering into freight forward agreements. And these are new opportunities that are being offered, where you can basically lock in your air freight price up to 2 years in advance if you have a product launch, or if you know that you are going to move a factory or things like this. Then you can basically cover this, not the risk, but the air freight spend that you will need to pay, and balance this off then with the development in the physical market. It's not us who is going to do this. We are just providing the index that is necessary for people to develop it. Currently, these products are developed by Freight Investor Services in London, but we are soon going to see other participants also launching new products. So having said all this, I think it's important to understand that we don't only explain to the industry how difficult it is, how unpredictable that it is, but that there is also light at the end of the tunnel, using instruments that are widely known already in the ocean freight, now being introduced into the air freight side. So that's last comments from me, and over to you, Nathan.
That was fantastic. Thank you so much for that information. For all of our viewers, there's more information about Neil and Robert's companies and the services that they provide available. So thank you again, and everyone else, please enjoy the summit. Bye.
Thanks very much.